Afternoon, everybody, and we welcome you to yet again another episode of our webinar series, which we call the Bizsmart webinar from Springboard Capital. It's always our pleasure to have you on board as we partake of this wonderful plate of wisdom. So lunch is served and we are glad that you're here with us. Now, last month, we focused on you, the business entrepreneur. We spoke about your health, what makes you well mentally, physically, so that you're able to run these beautiful businesses that we have been given to run. And together with the Niskize team, we actually managed to introspect and understand what we would need to keep our well-being for the sake of our businesses. And I hope that you've been speaking to Catherine and her team for your well-being. Now, in January, we had Miss Jen Batia. She took us through the legal tips for entrepreneurs. We looked at what does an entrepreneur need in terms of registration, what legal obligations does a business have to go through, and what is required to make sure that you're safe legally. During the question and answer session, it was evident that people wanted to learn a lot about the various responsibilities and emerging applicable tax obligations that businesses go through. And we at Springboard Capital are very focused on you. We listen to your voice, our customers, and we are intent on answering your questions. And it is in response to this that we have actually invited an expert in matters tax so that we can discuss this subject. At this juncture, allow me to introduce our speaker for today. We are very privileged to have Mr. Oliver Adera. He is an accomplished and seasoned professional with way over 30 years experience in accounting, financial management, and operational management as well. He is a member of the Institute of Certified Chartered Accountants, that is ISPAC. He's also a member of the Association of the International Accounting Professionals, and he's a practicing certificate holder. Currently, he is the CEO of DeLyde Associates, and later on he'll be telling us about himself and how we can be able to get through to him. Mr. Oliver, what a privilege to have you. And without much further ado, it is almost 10 minutes past. We shall begin. So Oliver, over to you.
Thank you, Anastasia, and hi to everyone. And thank you for inviting me to share my experience and knowledge on tax matters with your clients. So I will just go over straight to it. Very briefly, in 2 minutes, just to say who we are, who are DeLyde Associates. DeLyde Associates is a professional firm that provides audit, client accounting, tax, payroll processing, and management consulting services to local and international organizations. We've been in operation for 15 years. We have 30 people in the firm, 6 are support function and 24 client facing. And we do have large to SME clients in our client portfolio. We currently have 2 partners in the firm. And my previous experience was from PricewaterhouseCoopers, where I worked for 14 years before leaving at the end of 2006 to set up the firm. So I will go straight to the presentation because in my brief, I was told that the presentation is about 30 minutes and then to allow another 30 minutes for Q&A. So I'll go straight to it. I hope I can share the screen. So I will take you through the key components of a business. We will look at the types of taxes, the tax agency, advanced tax payments, related party transactions, and non-tax administration. To all the clients that we offer training to, we always have to start with this key bit on components of a business. So I'll spend a very short time, probably 3 minutes on it, but I feel it's extremely important before going straight to the subject matter of tax, but to understand how does this tax come in relation to your business. Your components of a business, and this applies to every organization. It does not matter whether you're commercial, whether it's a social enterprise. These are things that are there in every organization, whether it is planned for or not. Every organization has a product and a service that it sells. Every organization has marketing, whether it's a fully fledged marketing department or not. Every organization has marketing. Every organization, and these are the external facing parts of the business. Then you have the internal facing parts of the business. You have the internal facing parts of the business, which are finance and administration and human resource. Some may have human resource and administration combined, or finance and administration combined. Now, the key reason why I'm bringing this up, and you of course have ICT. And the reason why I put ICT is more internal, but I put it at the center because with technological advances, you then have all those facets of the business depending a lot on ICT in order to grow. The reason why this slide is important is that you find that most organizations concentrate on the external facing part of the business. They concentrate on the product. They may have a fantastic product, and they concentrate on the client, marketing, to get more business. And then they spend little time on the internal facing part of the business, which is equally important. And at the end of the day, some businesses will collapse or will close their businesses because they never paid attention to internal. Now, tax is part of the internal part of the business. And mainly in an organization will be handled by finance, or you may outsource it, but it's finance that takes the lead in managing tax matters. And that's the reason why I'm bringing this and saying that as a business owner, as senior management, you need to be aware that the internal facing part of the business are as important as the external facing parts of the business. It's like looking at the body of a person and saying that you cannot say that the leg is more important than the arm. All parts are very important. The moment one part is not there, the body will not function fully. So I ask that you pay attention to this, and the key purpose of this, it is brief, just to make you aware of the key areas on taxation, so that you may challenge your finance department or your consultant. You may know what needs to happen and when it needs to happen, so that when it does not happen, you actually take care of those areas and you query those. Going on to types of taxes. We have two different types of taxes. They are direct taxes and indirect taxes. Direct taxes, some of them, these are PAYE, which is on individuals, corporation tax, capital gains tax, and customs duty from importers. On indirect tax, we have value-added tax and excise duty. Value-added tax is on products, so practically everybody pays taxes when they purchase products that have VAT. Excise duty also, there are products like petroleum products and manufactured products that have excise duty, which then consumers pay for. On tax rates, POIE, you have graduated. POIE is computed on graduated scale, with the highest rate being 30% for income above 32,333. The taxes changed from January this year. The tax of 4,483 is for income up to 32,333. No tax, there's no tax on income up to 24,000. If you take the income, which is 10%, less the personal relief of 2,400, that's how you have 2,000. So people start paying taxes, those who earn from above 24,000. On corporation tax, this is a 30% on taxable income. So take note that this is on taxable income and not on accounting income. So you have to do your tax computation whereby you eliminate what is disallowed for you to arrive at your taxable income. Final tax is then paid after deducting installment tax stroke advance tax and withholding tax that was deducted by your clients during the year, if any. So you take the tax computed, that is the tax paid, the tax charge, less any installment tax you paid during the year, less any withholding tax that was deducted, and then that is the final tax that you actually pay. It is also important to note that when you're preparing your tax computations, that you could also end up in a tax loss position. When you're in a taxable income position, there's a tax charge and you pay tax. But you could find that you're in a taxable loss position, and this is allowed for you to carry forward to offset against future profits. Now, this is a benefit that would accrue to limited liability companies. If you're a partnership or an individual, you cannot carry forward losses. So you just need to bear that in mind in terms of tax planning, that if you're registered under Business Names Act, you are a sole proprietorship or you're a partnership. For you to be a limited company, you have to be registered with the Registrar of Companies as a limited company, and that's when this benefit would accrue to you. Customs and duty, this varies depending on product. Capital gains tax, this is 5% of the market value and not necessarily the sale value, but the market value. VAT, 16% of the VATable goods. Excise duty, this also varies depending on the product. Withholding tax varies, but the main rate used, which is mainly on professional services, is 5%. We also have withholding VAT, which are 2% of the value of services. So when I say value of services, you don't take the total invoice value. If you have an invoice, if a client has charged you 100,000 and they've added VAT, they'll have billed you a total amount of 116,000. So when you're deducting withholding tax, you apply 5% on the 100,000 and not 5% on 116,000. Same for withholding VAT. On remittance deadlines, POI is 9th day of the following month. And remember all these deadline dates. If there's a date that falls on a weekend, then you apply the earlier date, the working day before the deadline date. If 9th is on a Sunday or a Saturday, then your deadline date would be 8th in terms of payment. Corporation tax, we look at final tax and installment tax. Final tax is payable at the end of the 4th month after your financial year end. So using the example of an year end of 31st December, you have to pay your final, if you're in a payable position, you have to pay your tax by 30th of April. Corporation tax, the installment taxes that are paid every quarter, the first installment tax is on the 20th day of the 4th month after your year end. So again, using the example of 31st December, your first installment tax will be paid on 20th of April. Then the next one, second one will be 20th of June, then 20th of September, and then 20th of December. So you need to pick whichever year end, because we have organizations that have got year ends of 30th June, some 31st March. You just pick, use the number of months as provided. Customs duty, of course, payment before clearance of imported goods. When it comes to VAT, withholding tax, excise duty, and monthly rental income, which is abbreviated as MRI, this is on the 20th day of the following month. So if you're looking at VAT for February, then you have to pay it by 20th of March. I'll then just look at VAT applicability, and this is important especially for those who deal with foreigners. You bill foreigners, and this is very critical for you to understand, that is there in the VAT Act. So there are 4 quadrants to help you understand. You can have a foreign service or a local service. And in terms of client, you can have a foreign client, which means they're based externally, and you can have a local client. So the first quadrant there is the A, where the client is foreign and the services are local. A foreign client, maybe in the UK, asks you to do some work in Kenya. So the service is being provided in Kenya. The VAT Act provides that even though the client is foreign-based, the service is local, which means then the consumption is local. In this case, you will charge the client VAT. So you must charge the client VAT in this particular case because the consumption is local. The second quadrant B is where the client is foreign and the service is foreign. The same UK client asks you to do work in Uganda. In this case, both are foreign, and therefore you will not charge VAT. VAT is 0 rated. And bear in mind that there's a difference between 0 rating and exemption. Exemption means the service is not VATable, but 0 rate means the service is VATable but 0 rated. So in such cases, you must include VAT line in your invoice, but with 0 VAT. So I'll repeat that. Where VAT is 0 rated, you still must include that line in your invoice, but indicate that it is 0 rated. You then have the third quadrant, which is C. The client is local and the services are local. That is straightforward, it is chargeable. You then have the fourth quadrant, which is the client is local, but the services are foreign. In this case, you still charge VAT because the client you're dealing with is locally based. You have a client, a Kenyan-based client who has engaged you to do work for them in Uganda. When you're billing the client here locally, you will still charge VAT. So there's only one particular case out of these 4 cases where you do not charge VAT. This is where the client is foreign and the service is foreign. Let's go to tax agency. Tax agency is applied by KRA to ensure compliance and efficient administration of tax collection. Because, and you don't understand that there are some people who left on their own would not pay tax, and therefore the tax administration sees it fit to then give this responsibility to the structured organizations like an employer deducting PAYE. Taxes withheld or deducted by the agent at source and remitted to KRA by the due dates. So it is deducted at source. And it's important to understand that where tax agency is involved, the agent is not the one being taxed. It is somebody else being taxed, but the agent is deducting on behalf of KRA and then remitting. So the agency types, you have automatic, where, for example, like PAYE and withholding tax, you're not appointed in this case. You must just understand that you have an obligation under the law, under the tax legislation. Now, where you have employees, where you have a supply of services that is where withholding tax is applicable, you're meant to deduct these, and KRA does not have to expressly appoint you. Then we have other cases where you need to be appointed by KRA. These are withholding VAT. You must be expressly appointed, and withholding of rental income. Those are the ones where you must be specifically appointed, and they actually give you a letter to this effect. It's important to note that as an agent, and the moment you're running a business, just know that you're automatically a KRA agent because you'll have employees and you have to account for their taxes, unless you don't have employees and you don't deal with products that attract withholding tax. You will be held liable for failure to withhold and remit tax as if you are the taxpayer. So it's important to note that, and that is there in law. If you fail to deduct POIE and remit, KRA has the right to come to you and demand that tax as if you are the taxpayer. On withholding tax, this is applied on applicable services, and it may vary from 3% to 30% depending on the nature of service or product. Different rates for residents and non-residents, and I'll show you a slide where there are different rates that are applied for different kind of services depending on resident or non-resident. And non-residents can apply withholding tax deducted as advance tax payment where their country of residence has a double tax treaty with Kenya. So where you have a client, you have a supplier, a foreign supplier, and you have to deduct withholding tax, where they're from a country that has a double tax treaty with Kenya, you need to inform them that that will not be an expense to them. They'll be able to recover it in their country as advance payment of tax. So I've just listed this, and this presentation has been shared with Springboard, and they should be able to share this with you later. So I'll not go through this. This was just for your consumption later when you go through this, for you to know what are the payments where you need to withhold tax and what are the rates depending on whether it is a resident or a non-resident. And remember, in the definition, in the tax legislation, definition of a resident person for tax purposes is someone who has been in Kenya for an aggregate of 180 days, or let's just say 6 months. In total, you've been in Kenya for over 6 months, you're considered a resident for tax purposes. And then we look at double tax treaties. It's important to note that the lower rate may apply to non-residents where there's a double tax treaty. Quite often, lower rates are usually negotiated for. The double tax treaty must be ratified by the respective parliaments of the countries to the treaty for it to be in force. So this must be ratified. The governments can agree on it, but it has to go to parliament so that it's ratified. And remember that some of these at times could be challenged. An example is Mauritius. The double tax treaty with Mauritius was actually ratified by parliament, but someone took the matter to court claiming that due process was not followed, and therefore the court declared it null and void. And therefore those who deal a lot with Mauritius should note that the double tax treaty is actually not in force because it was declared null and void. Treaties are awaiting conclusion, or the bullet point before that, where the treaty rate is higher than the non-treaty rate, then the lower rate would apply. This can happen, especially when This can happen when you find that a treaty was entered to some years back, but later on, the government lowers a rate, and therefore you find the general rate is lower than the treaty rate. In such a case, the non-treaty rate, which is lower, would be applicable. Treaties that are awaiting conclusion or ratification are with Italy, Kuwait, Netherlands, Seychelles, Singapore, and Thailand. I've given there the countries that Kenya has a double tax treaty with and the rates that are applicable on the different areas of dividend, interest, royalty, and management, and you can have a chance to go through it at a later stage. Then we look at advance tax payments. What are these taxes that are paid in advance? So installment tax is not a tax in itself. It's not a type of tax because you're basically paying income tax. You're basically paying corporation tax. Installment tax is just an advance payment of corporation tax. So the actual tax you're paying is corporation tax. And as I've explained earlier, and some of you have encountered this is paid quarterly. You also then have advanced turnover tax, which is a very new item implemented from 1st of January. There are still gray areas in this advanced tax payment, and KRA is not sure themselves, taxpayers are not very sure. So your tax consultant or your accountant or finance manager needs to continuously engage with tax experts as there's more clarity in this matter to be sure that you're actually doing the right thing. But I'll get to it so that I can explain it. You have monthly rental income. This is on residential income, residential rental income. And then something very new also, just applicable, very much gray areas, digital service tax, because a lot of businesses are now, a lot of people are doing businesses online and they are not taxed. So the KRA, and not just KRA, all countries are now looking at ways of ensuring that they also get taxes from people who are operating online and selling to people in their country. So starting with installment tax, you compute this tax based on the previous year's taxable income. So once you've established your taxable income, for example, most organizations are undergoing audit to establish what their tax position will be for 2020, and they use the 2020 financials to compute the installment tax for 2021. So you take the taxable income and add 10%. So the assumption here is that your income will grow by 10%. So add 10% and then less any withholding tax. If there was any withholding tax deducted, you apply the withholding tax that was there in 2020. The figure you get, you then divide by 4 because you'll be paying it quarterly. Then this can be reviewed upwards or downwards quarterly depending on the management accounts. So once you've established the installment tax that you need to pay, this is not fixed, so you can revise it. You may find that you computed tax and then something happens like what happened last year on COVID, and your income drops significantly. It is not a must that you continue paying that installment tax, otherwise you'll end up overpaying tax. You are allowed to revise it based on your management accounts and then pay based on the revised position. This can also be upwards. You might find that you're actually doing better than the 10% you projected to grow. You can also revise and pay upwards because the tax law says that your final tax should not be 10% more than what you should have paid. Advanced tax. This, as I said, this is a gray area. It's a new, and we are engaging KRA and also consulting with more of our colleagues in the profession to ensure that we get this right. It is one minimum of 1% of gross tax. And I guess the issue is that you have a number of people who do not pay taxes, and the government is just trying to bring people more, especially in the informal sector, who do not pay taxes. Or some people who could be by design are continuously reporting losses, and KRA wants to ensure that some people pay taxes, and that's why they're saying you will pay no less than 1% of your gross turnover. The amount to be paid quarterly is the higher of 1% of gross installment tax or of turnover tax, of gross turnover, and installment tax, less any withholding tax. So you take your 1% of your gross revenue for the quarter and you compare it with the installment tax that you computed, and you pay the higher of the two. So as I say, there's still gray areas in this, and it's important to engage your finance person or your tax expert to guide you on this area. On monthly rental income, this is applicable to residential rent at 10% of the gross rent, and note that it is a final tax, and thus income, and the income is not accountable again when filing your annual returns. What it means by a final tax is that once you pay 10%, if you earn rent of 50,000 per month from your tenant, and you pay MRI of 5,000 every month, that is a final tax. You're not required to account for this tax again. You're not required to add this tax to your other income at the end of the year when you're filing your returns. Where real estate is an entity's business, and the entity can opt out of MRI and file. So it's important to note, some people, you may have individuals who have rental property and therefore have rental income. MRI is applicable to you. But you may have an entity whose business is real estate. And in the property that you have, you may have residential, a mix of residential and commercial. So you can actually opt out of MRI so that you opt to file returns just like any entity where you put all your income together. But you've got to apply for this to KRA so that it then approves that you actually opt out of MRI. Advanced taxes, stroke withholding tax, that are final. As I said, MRI is final tax, so you don't need to account for it again at the end of the year when you're filing your annual returns. Withholding tax on dividend is final. Withholding tax on interest is final, like when the bank, if you have a savings account or you have a fixed deposit and the bank deducts withholding tax on interest, that is final. And also capital gains tax. When you pay capital gains tax, that is then final, you don't have to account for it later. Related party transactions, this is important for you to know, especially when you have related entities. And it doesn't matter whether these are local or foreign. It's just important to know, and especially when they have transactions between each other. You may be owning a trading company and then you have another entity dealing with a different product, and at times they lend money to each other, they bill each other, there's some expenses that they pay on behalf of each other. Those are related party transactions. And where you are selling and buying products and services between related parties, you're meant to have a service level agreement to define this, because the reason for this is that KRA says that some people use this for tax evasion. And it is therefore important for you to have a service level agreement that spells out the terms of the engagement. And the purpose is to ensure that, one, your agreement is at arm's length. When it's tested, the prices you charge are comparable to market. And two, that it is applied consistently. You don't apply a rate this year when it suits you, and then next year, when the rate is not suitable for you, you change it. In that case, KRA will disallow that and will have their own assessment. So bear in mind that the rates you put between the entities should be at arm's length, and they must be applied consistently, so that when you have a change, you should be able to support it, even with market conditions. Probably you've been charging 5% to a related company, a sister company, and at some stage you want to change it to 7% or you want to bring it down to 3%. There must be some market forces that can actually justify that change. Then if you have a foreign related party, for example, you have an entity in Kenya, and then you've also set up a branch or a subsidiary in Uganda or Tanzania, and you still have transactions between those two entities, in that case, in addition to having a service level agreement, you will need to have a transfer pricing policy. So remember, these are for foreign related parties. Transfer pricing policy are important, and the transfer pricing policies need to be localized. We have some foreign companies that set up in Kenya, and they have a global transfer pricing policy. That is still not enough. You're meant to take that global transfer pricing policy and localize it, because you may find that there are some requirements locally that are not there in the global policy. And you should then pay attention to VAT applicability. I actually talked about the VAT applicability later, especially depending on when the related party is foreign or local. If you are billing a foreign company for services being provided in Kenya, remember, it's a related party, but remember, you must still charge VAT, as I explained earlier when looking at VAT applicability. Let's go to tax administration. Filing of returns, it's important for you to note, PAYE is monthly. Some years back, those of you who've been there and running their business for many years, you'll remember that PAYE returns used to be filed annually. You no longer need to file annual PAYE returns because of the iTax system that we have. You just file the returns annually. The only thing you need to do at the end of the year is for you to give your employees their tax deduction cards, which we commonly known as a P9. VAT is also then filed monthly by the 20th, PAYE is by 9th. Withholding tax returns are filed monthly by the 20th of the following month. Withholding VAT is also filed monthly by the 20th of the following month. And when I say of the following month, I mean if you're accounting for VAT for February, the due date, the date of filing return is the following month. And remember, you file the return and the payment also by those dates are provided. So there's filing return and there is making payment. Those are two different things. And it's important for you to understand. You can file a return, but then fail to make a payment. And you may fail to make a payment because you don't have the cash. You're facing cash flow challenges. What we always advise clients is at least file the return so that you don't then suffer double penalties. If you fail to file a return, there'll be a penalty for failing to file the return. And there'll also be a penalty for late payment. So at the worst, file the return so that you don't suffer penalty for not filing the return. If you don't have money and you have no way of getting the money to pay the VAT, then at least the penalty you will suffer will be for late payment, but not for failing to file the return. MRI, that's monthly rental income. The tax returns are by 20th. Corporation tax, the returns are by the end of the 6th month after the financial year end. Again, the example I used earlier, year end of 30th December, you need to file your return by 30th June. So remember, there's a difference between deadline for paying final tax and deadline for filing a return. So for some strange reason, the deadline for paying tax is on the 4th month, but the deadline for filing the return is on the 6th month. So we advise clients who are in a payable position to completely finalize their account so that they have a final position, so that they file their returns by the end of the 4th month and then make payment. Because then it would not make sense. You're filing your return at the 6th month, but you have to pay on the 4th month. If there are differences, of course, you'll have to pay that difference. But it's important that they tie up. So just completely finalize your accounts before the end of the 4th month, pay the tax and file a return at the same time. But remember, in all these taxes, you are allowed to amend your tax. You can make a mistake. These are changes that can take place. This iTax system allows you to amend, and it only gives you one chance to amend. So you must be extremely careful and sure when you're amending the return. And also consult with your tax consultant to ensure the right way in which you should amend or account for errors that you make. If you've amended a tax return and now you realize there's yet another error, the system will not allow you to. You'll have to go to KRA and explain to them, and they'll give you a hard time when you want to amend a return. And remember, if you're amending a return and the tax payable is reducing, the system will not allow you. You'll have to go to KRA because the tax is reducing. But if the tax is increasing, the system allows you to amend the return once. Penalties and interest. Penalties and interest will be automatic from the iTax system for non-compliance. Either you've not filed the return, you filed the return late, or you made the payment late. The general rates are 20% penalty on the amount payable, with 10,000 being the minimum, and 1% per month on amounts that remain outstanding. The interest method used is simple interest, and compounded interest method is prohibited. It's no longer allowed. Many years back, compounded interest was being used on VAT. Compounded interest means you're being charged interest on interest. However, simple interest applies, and it is only on the principal amount. Interest will not be charged on interest. Also take note that as a taxpayer, you have the right to apply for waiver of penalty and interest. You may have failed to pay tax for various reasons. It could be errors that are then picked out later on assessment by KRA, or it could be that you just didn't have the cash to pay and you paid late. What you need to do is to pay the principal amount. Pay the principal amount and then apply for waiver. You have every right, but nothing also stops you from paying both interest and the principal. Tax Procedures Act. It's important for you to know, and I'm picking this out mainly related to objection. That's the only bit I want to pick out, which I feel is relevant to you. As a taxpayer, you have the right to dispute an assessment by KRA and should lodge a formal obligation in writing and also in the iTax system within 30 days. So remember, KRA can come in and give an assessment and you're not agreeable to it, you dispute it. What you need to do is write a letter disputing it. Ensure that when it goes to KRA, it is stamped and signed received, because that's your evidence that you objected to it. You also need to go into iTax and raise your objection in iTax. So remember, it's not just delivery of a letter at KRA offices, but also going in and objecting through the iTax system. The commissioner may allow an application extension of time if, 1, due to absence from the country, sickness, or other reasonable cause, or 2, the taxpayer did not unreasonably delay in lodging the notice. The commissioner is required to make a decision on your objection within 60 days. And the 60 days are from the date of receipt of the notice of objection or any further information the commissioner may require. Some of you may remember, those who are familiar with the Tax Procedures Act, initially, when it came into force, the commissioner had 60 days to give a response. But it was realized that the commissioner was not responding within 60 days, and therefore the taxpayer's objection was the one that was then applied. So they amended this, I think, in 2019, where there was an amendment to the Tax Procedures Act that introduced that Roman 2, where the commissioner, the 60 days would run from the date the commissioner requests information. For example, if you objected to an assessment and then it is on the 29th day, so, sorry, it's on the 59th day because the commissioner is given 60 days. If the commissioner raises a query or asks additional information on the 59th day, then again 60 days run from that date. So the mischief here is that KRA can keep an issue for years because they can just wait for the 50th day or 59th day, raise another query, then you have to another 60 days run, and they can continuously do that because they realized KRA was losing a lot. So remember, if you raise an objection and KRA does not have a counter to it, that doesn't make a decision, then your objection is the one that would carry the day. Your objection would apply as per the Tax Procedures Act. And this was meant to ensure that there's efficient handling of taxpayers' issue. Then after that, if the commissioner makes a decision and it is not in your favor, as a taxpayer, you have the right to appeal to the tax tribunal within 30 days. But remember, if there is a portion of the tax that is not in dispute, then you're meant to pay for it before you can appeal. If KRA has given you an assessment of 10 million, but to you, it should be 5 million. You're disputing the additional 5 million, but you're not disputing 5 million out of it. You are required to pay the portion that is not disputed, the 5 million I use as an example, because you're only disputing the balance 5 million. So you're meant to pay that before you can appeal, for your appeal to be heard. Also, lastly, tax compliance certificate is important for you to have this, and we encourage clients to apply for it whether your suppliers have asked for it or not. It's just important, and especially for those who deal with government, because government will always ask for a tax compliance certificate. And applying for it is important because it will enable you to know if there's an issue on ITAX. At times, some people are not even aware that there could be an issue. But when they're desperate for a tax compliance certificate, that's the time when they realize there's an issue that came up 5 years ago and nobody knew about it. You may have had an accountant who left you 5 years ago and made some mistakes, and you're not aware. So you just come to the realization when you actually apply for a tax compliance. And therefore, we encourage clients to apply for tax compliance certificates every year, to have one, because they have a period, they're valid for 1 year, and this would help you a lot even when you're dealing with some private sector people ask for tax compliance certificates. So this can help in terms of business. And that's it. In terms of our presentation, as I said, I'll brief, and with the permission of the moderator, we can then go into questions, and we also have our contacts there. The firm, as I said, is DeLyde Associates. We are based in Upper Hill Geomap Center. We provided our telephone numbers. And as I mentioned earlier, as I was introduced earlier, I'm the Chief Executive Officer of DeLyde Associates. My email is there. We also have the tax manager whose details are provided there, and the tax senior. You can contact any one of us anytime you need some query or you need some assistance. Thank you very much, Anastasia. And over to you, Anastasia.
Wow. I am so educated. I feel like I can pass a KRA examination right now. Thank you so much. And we'll leave the screen, just leave your contacts there. Share the screen with your contacts, okay, so that as we look at the questions and answers, as we discuss the answers, we leave your contacts there for anybody who wants to pick them up. However, we will be sharing this this presentation with everybody. So we'll share our link to our WhatsApp so that everybody can be able to join there. Now, Oliver, we've got some questions on the chat, which perhaps we may want to start with. so that we can be able to get that clarity first, and then we go to any other individual questions that may come up. Paul Otieno, thank you very much for your questions. We also received some of your questions on email, which we shall be tabling today. I think the first question he's asking, is the maximum of 10 years still applicable? And what is the effect when it comes to the 1% tax on loss-making companies? I think with COVID, we've seen many companies starting to make losses. So where does that stand, Oliver?
Yes, thank you, Paul. The 10 years is still applicable where there's a taxable loss. So if you made a loss in 2020, you're allowed to carry it forward up to 2030. Thereafter, you lose it, you cannot carry it forward. So it's always important to bear this in mind and ensure that you're looking at this and consulting with your tax consultant to see if there are ways in which you can actually recover that tax. The other question was on the 1%. What that means is that once you've paid that 1%, our understanding, as I said, there are gray areas here, things that we are still clarifying. Remember that that is an advance tax. The tax you're paying is corporation tax, income tax as an entity. Therefore, this advance tax, you still must test it against your overall taxable position. You still compute your tax in the normal way. If you end up in a position where you have overpaid tax, then that is a tax liability that you can carry forward and offset against future tax liabilities. That is our understanding so far, that advance payment of tax is the same as installment tax. When you find that you've overpaid, you carry forward. That is a tax recoverable that you show in your balance sheet as an asset, which you can recover against future tax payments. Thank you. I think earlier questions sent to me that were shared to me by Springboard that were also asked for by Paul Otieno on KRA not responding to your queries when you're following up. When you are communicating with KRA, make sure your communication is in writing. And it should be official. Remember, yes, with technology today, you can use email. And in case you go to the tribunal, the emails will be admissible as long as they look at it and it's confirmed to be genuine. However, there are still risks with email. And that's why it needs to be official, where you actually write an official letter on your official letterhead. Go to KRA, have it stamped receipt, because then it becomes very important in the future when the matter is before the tribunal. And something else I forgot to mention is that even when a decision has been made in the tribunal and you're not happy with the decision, you have the right to appeal further to the High Court. So it's just good to note that the decision of the tribunal is not final. You can actually go and appeal to the High Court. So follow up with KRA, make sure it's stamped. KRA is very slow, and those of you, I'm sure all of us in business have experienced this. KRA is very slow, especially where they've got to deal with a matter that will result in a refund. But when there's a matter that relates to payment of tax, you can imagine how fast they are usually and how aggressive they are. So if there's a matter that you're following up, get a specific person that you deal with. They've had this system in KRA where they have relationship managers. Get to know who your relationship manager is so you can follow up with the relationship manager, but get to know the account manager. You can have a relationship manager and an account manager. The only challenge for taxpayers at the moment is that KRA has been having a lot of transfers, which is inconveniencing taxpayers a lot. You find that today you have an account manager. After 4 months, it's a different person. and you have to start all over again. So that is the frustration that most taxpayers are facing. But keep following up to ensure that your matter is dealt with. If you do not follow up and you're knocking on the desk of that particular person dealing with your case, then your matter will never be dealt with. The other question that Paul asked was deregistering from an obligation. Now, the example that Paul gave is that you may have an obligation because you had employees when, for example, you are a sole proprietorship, and then you change to a limited liability company, which is a separate entity with a separate PIN number. You're meant to write to KRA to ask for deactivation of the obligation. Because if you stop filing PAYE returns, the system will charge you penalties. So it's important for you to have that. Again, as I said, KRA is still slow. If it's something like VAT, continue filing nil returns until KRA actually deactivates. They're slow, and the system will continue charging you penalties for not filing returns. So it's just important for you to continue filing nil returns, even as you're following up KRA to actually deactivate it from the iTax system. So this can happen when, for example, you're changing, as the example that Paul gave, or when, for example, you are registering the company and then by mistake, an obligation was activated. For example, you're starting a business, you don't have employees yet, and you find PAYE has been activated. The system will be expecting you to file returns, yet you don't have employees. So in some of those cases, you can actually write to KRA to deactivate. I don't know if there's another question.
Yes, Oliver, maybe we can tackle one from Dominic. And my dear participants, I beg your indulgence so that today we may not finish exactly at 2 o'clock, just some more 5 minutes so that we can be able to tackle this one. So Dominic is asking that you could please clarify something about the voluntary disclosure program that is effective 2021 per Finance Act of 2020.
Mm-hmm. Yes, the voluntary program is running, I believe, 3 years, and it's dating back, I think, 5 years financials. And it's important that you take advantage of this, especially issues to do with errors. Get a tax consultant to carry out tax health check audit for the years I've been provided for, to establish if there's any exposure. Once they've established the exposure, then you discuss and agree on how to go about it and how to present it to KRA. And then you can apply for this and you bring out taxes that are payable. The penalty and interest will be automatically waived, as opposed to the periods when there's no amnesty. Because where there's no amnesty and you apply for waiver, then that depends on the discretion of the commissioner or the cabinet secretary of treasury, if it's beyond a certain amount. And that's at their discretion. So remember that if you have issues right now, it's best to apply right now, because when you apply the waiver of penalty and interest, you'll be entitled to it, and it will not be then at the discretion of the commissioner. But remember that the commissioner can still disallow waiver if it is then discovered that there was no full disclosure. And that's why you've got to undergo a tax health check audit and discuss with your tax consultant how you want to present this. Because if it's later on discovered that you still did not disclose some important issues, then that waiver will be clawed back. Thanks.
One last one, because many of our customers are actually in real estate. Some are purely on real estate and some are not purely in real estate. So please clarify, this is from Karevi, please clarify the filing of rental income for individuals who have got more than one income source, and yet they're not trading solely as real estate?
In that case, MRI applies to you. First of all, first and foremost, MRI is applicable on all rental, domestic rental income. It's applicable to all, whether that is your business or you're just an individual who has one or two properties. It is applicable. What I mentioned earlier is that if real estate is your business, you can opt out of MRI and you've got to apply for it to opt out so that you file your returns the way you can account for all your income in its totality. So remember, if it is residential, then it is applicable. It is mandatory that you actually file monthly rental income returns and pay that. And as I said, it is a final tax. So I hope I've made it clear in terms of that distinction. It does not matter whether you're corporate or individual. MRI is applicable on your residential property, but you can apply to opt out of it. Thank you.
In lending you money, but customer education is key for us. We are interested in educating you to ensure that you run your businesses in the most efficient way. Your success is our success. Thank you very much, everybody. This is our logout from Springboard Capital, the lending hand.